this is an environment where we have not yet retested the lows. Do you feel as though, from a strategy standpoint, you could see a retest of the lows that we saw post-tariff announcements?
Yeah, well, great to be with you, Dom. And to answer your question, yeah, I think if you look back at history, a more common pattern for the market is a retest. The V-shaped recoveries, which have become somewhat more accustomed over the last decade, we think is less likely because most of those V-shaped recoveries occurred because there was a policy response on the fiscal side or the monetary side, and we think the policy side is somewhat constrained. I think importantly, even though we're likely to have somewhat of a short-term bounce here because the market is a little bit oversold after last week's selling pressure, we think the upside is likely capped in the 5,400, 5,500 for the S&P.
Keith, what do you think would trigger a policy response, either from the fiscal side, and again, that's the administration, so very different in terms of what they want their long-term path to be, but specifically from the Fed? There always has been this Fed put notion that's been out there, certainly since the great financial crisis. Do you feel that's in play at any point over the course of the next several months or quarters if things get worse?
Yes, and I think the Fed will likely cut rates this year, but they're likely to lag what is actually needed to be less proactive because of their dual mandate and scar tissue around inflation. So even if they come in, it's not going to be like 2020 where they came in with the bazookas, both the fiscal side and the monetary side, because normally when you have this kind of oversold market, the VIX spike, you tend to have that policy response, which when you look forward 12 months later, the market tends to be higher. And I think maybe there's still a positive skew, but I think one thing that has restrained our view relative to history is that we just think the Fed is more likely to be less assertive given the circumstances. And on the fiscal side, we're actually seeing some fiscal constraint as well. So again, that leads us to the view that the upside, even though we likely have it on the very short term, is likely somewhat capped.
Keith, it sounds very much to me like you're cautious. So let's take us through now your word of the day and why.
Correct. We are cautious. Our word of the day is defense. So as we get these bounces from these oversold markets, we would suggest at least being moderately defensively positioned. And that's what we're doing. By the way, Dom, I know a lot of times people want to talk about red light, green light, all in or all out. We're not saying that, but we're just saying relative to long-term equity targets, we would be somewhat below that, given in our work, which is more of a mixed risk reward. And we do think the economy is certainly slowing and likely to hit some type of air pocket later this year as we do all this front running of inventories and so forth. And at the same time, we haven't really seen those forward earning estimates cut yet, which we think there's more to come on that side.
And Keith, before we let you go, your favorite sector out there, given your defense word of the day.
Well, you gave it away a little bit, Dom, but it's utilities. And I think in a world where you have tariff risk, utilities are less influenced by that. Also, in an economy that's likely slowing, we expect more stability on the earnings side. The technical trends are relatively positive as well. So not going to be a gangbuster on the upside, but on a relative basis during what we think will continue to be a choppy market and has a 3% dividend likely to outperform in our view.